You pay extra money, and the extra money you pay gets you a lower interest rate. Today's topic is regarding buying down points. Now, for everyone that doesn't know what that means, when you get a loan, either you buy a new property and you get a brand new loan, or you're doing a refinance. When you're doing that, in that process, you have an opportunity to buy down points. So what that means is you pay extra money, and the extra money you pay gets you a lower interest rate. And there is mathematical calculations to determine, is it beneficial for you? At the same time, your time horizon, how long you're keeping the property, is really going to affect should you buy down points, and if you should, how much you should buy down. So there's calculations. Now, if you're planning to keep the property 2 years, 5 years, 10 years, for your whole life, it changes what number is beneficial for you. And that's really what you have to determine, is how long you're going to keep the property, because that's going to determine if it's beneficial or not. So enough said regarding determining timelines. What I normally do and how I normally do things is I actually run the numbers first and then determine, how long am I actually going to keep the property? So let's run through some examples, and these are actually current market examples. This example is for a $500,000 property that has a $350,000 loan. The person has above a 720 credit score, and the individual, is a W-2 earner. It's just standard stuff. So again, $500,000 purchase price, $350,000 loan amount, over 720 credit score, and we're doing a standard rate and term refinance, no cash out. Okay. And these are the numbers based off of today's numbers. So I just went into the system and pulled them up. And for those that don't know, I'm a broker, and I used Quicken Loans for these numbers quickly. They're one of the 5 companies I work with. We currently do loans in Florida and New Jersey. We're in the process of getting Texas and California. And after that, we're going to be doing Arizona, Washington, Illinois, Oregon, New York. We're going to have many states covered. So any of you guys looking to do refinances or purchases, we're happy to help. And for those that don't know, anyone that buys my course, the purpose of the course is to help educate individuals so they're able to buy rental properties and expand their finances. Anyone who buys my course and learns and grows, when it's time to get a loan, feel free to contact us, and we'll actually give you a credit back for the cost of the course. So that's going to be very helpful, because the point is to educate individuals and build their own financial freedom, and along the way we'll help you with getting the financing for the property, and we can also help you with taxes and insurance, property insurance, auto insurance. So I really wish you all luck with everything, and let me show you here now the numbers. So in this first example, we're going to go over the start rate right now is 3.5% interest, okay? 3.5% interest, they will pay you $539. You're actually going to get paid to take a 3.5% interest rate. Now, you would think, well, why is that? The reason you're getting paid is because this rate is higher than what the standard rate is right now. The next option I have here is 2.99% interest. And in this example, they're paying you $1,400 for this rate. Now, you would think, wait, you're telling me, Pascal, they're actually gonna pay me more money to get a lower payment? And the answer is yes. They will actually pay you more money for this lower payment. The reason being for that is that they know if you get a 2.99 rate, you're likely to keep this loan longer. And there is the people who are buying these mortgage-backed securities, the packages of loans, don't want you to refinance. They don't want you to get rid of the home. They want you to keep that loan forever. And they know at a 2.99 rate, you're a better chance of keeping that loan longer than a 3.5% rate. And that's, you can tell by pricing, is the market's trying to push you towards a certain decision. In the next scenario, you got a 2.69 rate. 2.69 rate means you're gonna have a smaller payment, right? As we go down in interest rate, you have smaller payments. At the 2.69 rate, it's gonna cost you a one-time fee. You're gonna have to pay this. You're gonna have to pay $2,751 for a 2.69 rate. And the next rate after that, in this example, is 2.5%. You're gonna have to pay $4,403 for this rate, this lowest rate in this example. Now, which option is the best? Let's run the numbers, and the numbers are gonna help us decide. Got my little cheat sheet here. So in the first example, we're gonna go from, so let's right now skip this. We're not gonna look at the difference between 3.5 and 2.99. The reason is, it's pretty simple that I would rather have a smaller payment and get paid more to take a smaller payment. It does not logical for me to have a higher payment and get paid less. It doesn't make any sense. So really no one's gonna take this option. This option is the minimum option and below. So what we're gonna do is, the first example, we're gonna look at the difference in 2.99 and 2.69. What is the rate and difference in payment, and what is the difference in cost? Because this is the cost up front to buy the points. Okay, so a 2.99 rate cost $1,473.73. $1,382.93 is your 2.69 rate. That's $90.80 a month times 12 equals $1,089.60. $1,089.60 is how much you're gonna save in 1 year by having the 2.69 rate compared to the 2.99 rate. That is your annual savings. Now we see here in this example, we have they're gonna pay you $1,400 to get the 2.99 rate, but you have to pay $2,751 for the 2.69 rate. The difference between these two is $4,211.50. That's how much you have to pay, $4,211 to save this $1,089.60 a year. What does that mean? Correction. This is actually the wrong rate. That's what I get for scribbling. I put the wrong rate because I actually put this rate down here. So it's actually $1,473 for the 2.99 rate. The 2.69 rate is actually $1,417.75. The monthly savings is $55.98, so the annual savings is $671.76. The cost is $4,211.50. So again, between 2.99 to 2.69, the savings is $671 a year. The cost for going from 2.99 to 2.69 is $4,211. The return on investment for that is $15.96%. So 16% is your return on investment for choosing to go from 2.99 to 2.69. That is your return on investment. So what you have to think is, for this to be a good deal, you have to keep the property for at least 7 years. That's roughly your return on investment. 7 years is how long you'd have to keep it. Now in this example, I normally don't like those odds. Personally, to keep it for 7 years, so the odds are this. For a person to the statistics are an average individual is either going to refinance or sell their home every 5 to 7 years. So if that is the statistics and you're going to have a 7-year recoup period, then the odds are probably not in your favor that you're going to keep the home longer than that. Now, I think things are going to change a little bit. With rates as low as they are, 2.99, 2.69, and in 5 years from now, I don't think rates are going to be this low. The odds are that there's probably a good amount of people that are going to start staying in their home longer than 7 years. So you're going to have to measure that and determine if that's going to be your situation. So let's go through another example. Let's see if you are a person, you're like, you know what, I'm going to be in this home for a very long time. I'm going to keep this rental property for a very long time. Let me run a scenario. Let me see what the difference is between 2.69 and 2.5. And this is very unique, this situation here. You're going to see something very weird where it's very interesting. So 2.69 rate is 14.1775. The 2.5 rate is 13.8293. That's $34.82 times 12. In a year, that's $417.84. Now, some people would say $400 a year is not a lot of money. But you gotta remember, all of these things add up and become something significant over time. The difference between a 2.69 rate and a 2.5 rate is $1,652 one time. That's a 25% return. 25.29% return. 25.29% return. Where can you spend $1,652 and make 25% return guaranteed for the next 30 years? Honestly, I really don't know. There's very few places that can give you that type of guarantee. Warren Buffett just looks for a 15% return when he's making a decision on if he should buy a company or not. Can you consistently make 15%? In this decision, you're consistently making 25% return. And if you keep the property for 30 years, you're guaranteed to make this return. Now, the interesting part here is that's between 2.69 and 2.5. But between 2.99 and 2.69, it wasn't that good. It was around 16%. So let's run one more scenario. Let's run another scenario from 2.99 to 2.5. Let's see what that matters. Because the reality is this. When you're looking at a loan, you're looking in between this and this. 2.99 and 2.69. That right there is about 16%. Between these two, the middle number and the low number is about 25%. That normally does not happen. Let me tell you, we are in very unique times. It is not normal for us to go through, get lower in the numbers and actually get a better return. It's very rare. So we're gonna run one last set of numbers, which is between 2.99 and 2.5, okay? All right, 2.99. At 2.99, we're looking at 14.7373. At 2.5, it's 13.8293. That's 90.80 for the year times 12 months equals $1,089.60. $1,089.60 a year is what your savings is by buying down the rate from 2.99 to 2.5. The difference between those two is $5,813.50. That is an 18.74% return on investment. If you pay $5,813 one time in this scenario, you will save $1,089.60 a year for the next 30 years. That's an 18.74% return annualized. And basically, it's about 5.5 years before you get a return on your investment. When you look at the big picture, in this scenario, if you're planning to stay in the home longer than 5 years, especially if you can roll in the cost of your closing costs, I think this is a good situation to be in, a good position. A big factor, in addition to the fact that you're going to make your money back in 5.5 years, you're going to annualize almost a 19% return on that decision, you're going to have a lower monthly payment. Your DTI is lower. And why is that important? Because when you're looking to get more loans, more properties, your DTI is one of the biggest factors that is holding you back from getting additional properties. So the more that you can lower your monthly payment, the better the chance, the more you increase your odds of getting more properties in the future. Know your numbers. And if you aren't the best number person, real estate's still a great business because relationships and decor and proper investing in great areas and salesmanship is very important. They can actually beat the numbers person. But it doesn't hurt to have a numbers person on your team. So if you guys have any questions, need help with loans, or need help with financing, let me know. I'll be happy to help.